Margin investing is a strategy that allows investors to borrow funds from a brokerage firm to purchase securities such as stocks, bonds, or mutual funds. While it can amplify potential returns, it also magnifies risks. Understanding how margin investing works, its benefits, risks, and strategies for managing those risks is crucial for any investor considering this approach. What is margin investing? Margin investing involves borrowing money from a brokerage firm to buy securities. This borrowed money acts as leverage, allowing investors to increase their buying power and potentially amplify their returns. In essence, investors are using their existing securities as collateral to borrow additional funds. How does margin investing work? When an investor opens a margin account with a brokerage firm, they can typically borrow up to a certain percentage of the value of their eligible securities. This percentage, known as the initial margin requirement, is set by the brokerage firm and is subject to regulatory guidelines. For example, if an investor has $10,000 worth of eligible securities in their account and the initial margin requirement is 50%, they could borrow up to $5,000 from the brokerage firm, effectively doubling their buying power to $15,000. Benefits of margin investing. 1. Increased buying power. Margin investing allows investors to leverage their existing assets to potentially increase their purchasing power and exposure to the market. 2. Potential for higher returns. By amplifying their investment positions, investors can potentially earn higher returns than they would with cash-only investments. 3. Flexibility. Margin investing provides investors with flexibility to take advantage of investment opportunities without having to liquidate existing positions. 4. Diversification. With margin investing, investors can diversify their portfolio by accessing a wider range of securities than they could afford with cash alone. Risks of margin investing. 1. Magnified losses. While margin investing can amplify potential returns, it also magnifies losses. 1. If the value of securities purchased on margin declines, investors may face margin calls and forced liquidation of assets. 2. Interest costs. Borrowing funds from a brokerage firm incurs interest costs, which can erode investment returns, especially during periods of high interest rates. 3. Margin calls. If the value of securities purchased on margin falls below a certain threshold, investors may receive margin calls requiring them to deposit additional funds or liquidate assets to meet margin requirements. 4. Market volatility. Margin investing exposes investors to increased market risk, particularly during periods of high volatility when asset prices can fluctuate rapidly. Strategies for managing margin risks. 1. Maintain adequate margin cushion. To reduce the risk of margin calls, investors should maintain a comfortable margin cushion above the minimum margin requirement. 2. Monitor portfolio. Carefully. Regularly monitor the value of securities in your margin account and be prepared to respond to changes in market conditions. 3. Use stop-loss orders. Implement stop-loss orders to limit potential losses and protect against sharp declines in asset prices. 4. Avoid over-leveraging. Exercise caution when using margin to avoid over-leveraging your portfolio, as this can increase the likelihood of margin calls and significant losses. 5. Understand margin terms and conditions. Familiarize yourself with the terms and conditions of margin accounts, including interest rates, margin requirements, and margin call procedures. Margin investing can be a powerful tool for investors seeking to maximize their potential returns and diversify their portfolios. However, it also carries significant risks that require careful consideration and risk management. By understanding how margin investing works, its benefits, risks, and strategies for managing those risks, investors can make informed decisions about whether margin investing is suitable for their investment objectives and risk tolerance. As with any investment strategy, it's essential to conduct thorough research, seek professional advice if needed, and exercise caution to mitigate potential risks.